welcome to the Founder Institute. The Founder Institute is the world's largest pre-seed startup accelerator, having helped launch over 5,000 companies across 200 cities and 6 continents. We help pre-seed entrepreneurs and teams get to traction and funding by establishing a critical support network of local startup experts that are invested in their success, and by providing a structured and challenging business building process that has helped our alumni raise over $1 billion. Leaders of the world's fastest growing startups have used the Founder Institute to raise funding, build a co-founding team, get into seed accelerators, generate traction, recruit a team, build a product, transition from employee to entrepreneur, and more.
Good evening, ladies and gentlemen. Welcome to Learn from Top African Startup Investors, How to Raise Funding, Ask Me Anything, our online event hosted by Founder Institute. If you've been trying to raise funds for your startup, if you are considering raising funding, you know that it's scary, it's unpredictable, and it's challenging, to say the least. To make it slightly less scary, we have some investors today that can help you get some idea of what it's like and what you need to look out for. Ladies and gentlemen, I want to invite you to meet our panelists, and we can start with the Ask Them Anything. Ladies and gentlemen, let us meet our panelists in a bit more detail, and we're going to start with Bade. Bade, can you tell us a bit more about yourself, and then also tell us how you first came involved in the startup scene?
All right, thanks, Jacob. That's really nice to meet you guys again, and fellow panelists, it's great to be with you. Close to 30 years, and I spent also about 20 years of those in corporate Africa. And towards the last decade of my career, I started engaging as an angel investor. And typically it started with either people that knows me and come to say, hey, can you help us with this startup we are trying to do? Or, hey, can you be a part of our advisory or a board member? Or can you invest? And that's how I started. When I retired in 2019, I then decided to take the business a bit more serious, if I could say that. So I started the venture capital fund. And I went through the accelerator program of VC Lab, and I started a venture capital fund, and we invest in early stage businesses. That's a short intro to me, if that's okay, Jacobs.
Thank you very much, Bade. Yeah, we see each other every second week in the program. Thank you very much for the effort there. Our next person that will be introducing himself is Andre de Wet. Andre, please tell us how you got into the startup game and a bit more about yourself.
Guys, firstly, great to meet the panelists. Great to meet everybody that's on the call. I myself am an entrepreneur that came out of a study direction. I did a couple of years of med school and then decided I don't want to be a doctor. So I started selling stuff to the fellow students and started my first business back in the day when venture capital didn't exist, and everything that you sold is the money that you could use to build the next level and the next level and the next level. And subsequent to that, come from a background working in the Naspers stable, built companies like PriceCheck across Africa, built iFlix across Africa. I've opened up offices in 5 Western countries in Africa. I have put teams down of 80 to 100 people I sit on the mentoring boards for Endeavor, Techstars, Stellenbosch Launch Lab. I help a bunch of others, founders. Future Females is one of the groups that I helped with their initial mentoring. Help companies move their IP around. And not only that, not only do I help and assist and raise, but I'm right in the middle of a raise myself for something that kind of a project we've been working on for about 4 years. We've had about $300 million worth of GMV through the platform, and we're coming out of stealth, and we'll be raising soon. And so I'm sitting on both sides of the fence, and that's nice because I get connections. I have a vast network of people in Silicon Valley, New York, Boston, those areas, and then in the UK. I lived there for a couple of years. So a nice network of people that I bring to the Founders Institute itself. I sit on the mentoring board here and bring everybody that's on the call some of the knowledge and information, as with the rest of my panelists. Great bunch of people. Thanks, Jacobus.
Thank you very much, Andre. And the next person that we're going to ask to introduce himself is Joshua. Joshua, please tell us a bit more about yourself and how you got into the startup game.
Sure, thanks. So I'm a lawyer by background, and I got a chance to work for one of the leading DFIs around as part of the legal department, and that's when I realized that my job was going to be boring, and I decided to move to the investments and business sides of things. Transition to a development consultancy, spent time there, then currently on a more research-oriented role with Brighter Bridges. And what I'm seeing is that there's been a growth in democratization of angel investing, and that's pretty much how we got in.
Thank you very much, Joshua. Ladies and gentlemen, just a quick reminder. Please, you can post questions on the Q&A already for the panelists as we get to the AMA section of this event. Also, if you want to ask a question personally, you can raise your hand and we will put you on the list of people that can ask questions. Thank you very much, Joshua. I think let us go to Hema. Hema, please tell us a bit more about yourself and how you got into the startup game.
Sure. Hi, everybody, and thank you, Cobus. Yeah, I think for me, it's been quite an interesting journey. I always say I'm an engineer turned entrepreneur, now turned investor. So very much the antithesis of a typical fund manager who most people are used to meeting. But I think while it's a very organic, but at the same time, very deliberate journey. Like I said, I'm an engineer by training. I did work in the oil and gas space for a couple of years in what feels like a past life. But when I was still studying, I started a nonprofit organization at the time supporting girls and women in engineering, and really seeing the barriers that faced. I'm from South Africa. The organization was based in South Africa, but also when I worked abroad, realizing what a global issue this was. So for the last 17 years, I've been building out Womanish, which really supports and develops the talent pipeline for girls and women in engineering. But in 2013, started doing a lot more work in the entrepreneurship and innovation space, and realizing, the potential for helping, supporting female-led businesses. So spun out of Womanish to then start WomHub, and WomHub today is a boutique incubator, accelerator, and as of September 2020, the very first innovation hub and co-working space for women in tech in Africa. So, we've really been supporting female-led innovation from developing businesses, being a female founder myself, just really been looking to support and develop and really scale and grow these companies. Between Womanish and WomHub, we've worked in 24 countries around the world, with a strong focus on the African continent. And that's been going great. But I fast realized that one of the biggest bottlenecks was the lack of capital being allocated and invested into female-led businesses. And a large part of that reason is the lack of females at investment decision-making tables. It's an honor for me to be here with my esteemed panelists, but this is being 25% of this panel being female, that's a big number. Usually it's even smaller. And until we have more women fund managers, women on investment committees, we're not going to see the needle shift fast enough. And that's sort of the baton which I've taken on in the last couple of years. And I'm now raising my first fund called 535 Ventures, which really speaks to our mission. So we know if we add more women entrepreneurs to the African ecosystem, we could see up to a 5% GDP uplift. And that's really by leveraging the 35% higher ROI we see when we invest in women-led businesses or diverse teams over all male-led teams, if the playing field was level. So it's really about opportunity. It's about, there's returns to be had. It's not just impact. The VC world, as I'm sure we'll speak about, is about, growing and scaling and making money, but the two aren't mutually exclusive. So that's the journey I'm on at the moment. A large part built of my own experience, but also just working with an incredible team that's, really shifting, creating a paradigm shift in how investment on the continent is done.
Thank you very much, Simone. It's very interesting. One of the things that's fascinating to me is the area that you're working in. So now I said Simone because I know Simone is up next. Thank you, Hema. So let's start with Hema. Simone asks, what are the typical mistakes? What typical mistakes do founders make when trying to raise funding? And I think let's start with Hema.
Sure. The list is long and exhaustive, and I'm sure the panelists, especially many of those who are entrepreneurs themselves, I know I've made many mistakes in mine. But I think the one I've learned, and I think this is a lot of entrepreneurs, but I dare say women do it more often, is don't let perfection hinder progress. Sometimes we wait for the perfect product. We're waiting to be 100% ready. We're waiting for everything to be beautifully articulated before we even start this journey into raising capital. And I think one of the things, it's about just getting started. So we're a seed stage fund, but for seed stage funds, pre-seed funds, angel funds, if they are the right mentality of investors, they're not looking for a perfect product or a perfect MVP. So just put yourself out there, cast it far and wide. And I think for me, that's something, if I could go back and do it again, that's something, a mistake I would have fixed in terms of, one of the things I see happen more often.
Thank you very much. Bade, do you want to add anything there?
Yeah, I think to support Hema, I'm going to be talking from the venture capital point of view. One of the biggest mistakes that founders always make is not to understand what is the space in which that a particular venture capital plays out. So if you are an early stage company, let's say you're a pre-seed stage company, and you are trying to look for funding, and you're busy talking to a Series A VC company, you have a mismatch. So one of the first things that a founder needs to do when you decided that it's time for raising fund, one is to identify what are the possibilities within your space. Who are the players within your space? You have to do a lot of research. All right, you have to understand what type of company do they fund? Are they funding companies that are in the space which you are in, industry? What is their ticket size? And what do they typically look at? So it is important for you to understand that while it is easy to get funding, you must approach appropriately the institution that matches what you are doing at the time in which you are doing it for the appropriate funding.
Thank you very much, Bade. Joshua, do you have anything to add?
Yep, 100%. So I do agree with Bade that there's very little research that is being done, especially by founders in terms of understanding the investors. But secondly, I would also say that founders need to spend a lot more time building relationships with these investors, right? Be out there, be seen, be visible, and build that relationship, seed it. And in as much as the investor is not in your cap table, make sure that you have strategies to capture their interest, be it by way of them being part of your newsletters and sending out regular communication to them.
Thank you, Joshua. And then Andre, anything that you want to add?
Guys, yeah, an interesting point there, or interesting pieces of the discussion, and everybody's touched probably on all the most important things. To me, one of the big key aspects and the key things around this is, if you have a great product and you're solving a problem, you're going to get to the right kind of people. Yes, get out there, speak to the right people, make sure that you match and speak to the right kind of people. But more importantly, make sure that you've got a great team and have a great product. And we'll cover that as the day, as the evening progresses. More about that and more about what you need to get out there, and then taking a look at the few at the structures and the pieces of the puzzle there around distribution and distribution not only of the product, distribution of your thinking and how you get it to the different VC players and the funders, because funders have all kinds of different ways that they come across.
Thank you very much, Andre. And I think before we go to Visani's question, because it's important that we get a bit of context. I think the first thing I'm going to ask the panelists is sources of funding. So there isn't only one source of funding. We're always thinking in terms of investment funding, but there's different sources of funding for startups. And I just want to hear from the panelists what sources of fundings are available for startups.
Jacobus, I want to climb in here quickly and just just make an interesting point here. And I just want to underline the a line of thinking here. I was recently speaking to a company that had funded a product, and they built the MVP, or the first part of the product. It was saleable, and they were like, okay, now we want to take this product and add to it. So we're going to raise venture capital. And what people forget to understand is, I want you sometimes, when you have a startup, to take away the aspect that there is venture capital available. Answer that question first. This is crucially important. Can you sell your product, and can you raise funds without venture capital? Does that mean you've got to go and knock doors and pick up the phone and sell your product and get clients? Because if you do that right, one, you might get to a point where you never have to raise funds. Guys, raising funds sounds fun and it sounds like excitement, and people pop champagne when they raise funds. You know what should happen when they raise funds? They should all go into panic, because you've got to pay that money back. Or you've got to create a business that gets a return. Now, everybody, yeah, we raise funds. No, dude, you owe that money to someone. Yes, you've got a great idea and you've sold a great story, but you've still got to go out there and do the work. If you can raise a business without raising funds, and this is, I'm not taking away from what today's talk is about. I just want everybody every now and again to understand that if you have a product, get out there and go and sell it. There's a guy out in the street right now that is hustling. If you want to mine gold, you don't sit in a coffee shop and talk to people about how I'm going to raise funds for the mine that I'm going to build. You know what you're doing? You're growing into the ground. You're going in there where it's dirty and messy and oily and mud and everything, and you take the gold out of the ground. That's how you make money. Not by sitting in a coffee shop and telling guys, you know what, under this coffee shop, there's a massive mine and a line of gold and we can raise all this money. No, man, go dig that hole and go do the work. People must not forget that aspect. So I just want to add that into it. We get so caught up in this whole aspect of fundraising. You know what? Also get out there and go and build this.
Thank you very much. I know Bade definitely agrees with you. Bade, is anything to add there?
All right. Well, I was going to say that I'm a firm believer that if you do not need fund, don't go raise it. The reason being that every time you go to raise fund, you dilute your interest. Exactly. But be that as it may, let's understand one thing. It's not every founder that has fund or resources or reach within their immediate space to raise fund to fund their business. So let's go back to the question. What are the different types of avenue for raising fund? I think the question will start with, it depends on which stage of your business you are in. Every single stage of business have peculiar potentials of fundraising. If we start from the pre-seed typically means that you are not yet any revenue, you are pre-revenue. And at that stage, at the pre-revenue stage, you're probably more concerned with creating your MVP, your minimum viable product. It is a general belief in the industry that at that stage, you need to mostly start by raising funds from your friendlies, your colleagues, and your family. those who believe in you, who understand your capacity, and who can share your vision. The other aspect is that if you have exhausted that angle, then you can go after angel funding. An angel investor is typically an individual or a set of individuals who have the same philosophy, and they also define what type of investments they want to do. So they might be, oh, we are going to do only fintech investment, or we are doing impact-based investment. So you could go after an angel investor. Their ticket size are usually very small. Sometimes it ranges from as low as $15,000 to about $100,000 in our market being African market. You could do crowdfunding. Crowdfunding is a system whereby you join crowdfunding platforms and you advertise your idea and ask people to take equity interest or a note interest in your idea, and you can raise money through that way. What usually happens is that most of the time we assume funding is only for venture capital. As a matter of fact, if not for of recent, venture capitals usually like to fund growth or revenue-based projects. But now we have venture capitals that are funding as early as pre-seed. They are typically also behaving like angel investors or angel lists who would try to understand your business and the idea and the team, and they would typically be interested in funding you as well as helping you through mentorship and access to the industry. So there's a whole wide of funding mechanism depending on the stage that you're in. But once you get to Series A and above, which is growth stage, at that stage, predominantly, you are basically probably raising a venture capital fund. Now, it is important to also note that a venture capital fund could either be as a convertible note or an equity investment. So depending on, but even if it's a convertible note, it's still expected to convert to shares at the end of the term of the note. And typically, this is common in the seed stage of your investment. So depending on where you are, there are various options that are available to you. But if you are starting afresh, every investor likes to see how much skin you have in the game. So if you yourself or those who are closer to you are not ready to put money down, then why are you asking somebody else who's a third party to put money down? So you are expected to have look for some source of funding through your own personal capacity or your friend circle or your friendlies or family before you can start asking third party to invest in your business. Thanks.
Thank you, Bade. I think you covered most of it. Joshua, is there anything that you want to add to that?
Absolutely. So, I mean, we see that quite a significant bunch of the funding goes to, as Bade mentioned, the VC side, and this is mainly equity, right? But to add on to that, we are seeing a lot more, development in terms of grants as well. So a lot more, donors and foundations are investing into the continent startups and are, creating new, financing structures such as, revenue-based finance, right? Other sources include, accelerators that in a way also connect startups to angel investors, as well as, crowdfunding platforms such as Seeders, Tunda Fund, Trine, especially for those that operate within, the cleantech space. So there is a myriad of funding, but, the larger majority is pretty much equity and, VC-based financing, especially for startups and not really SMEs or, subsistence types of businesses.
Joshua, Hema, is there anything that you want to add?
Yeah, thanks so much. There's actually 2 points I want to make. And I know just where Andre started, I couldn't agree more that, VC funding is not for everybody. It's a very sexy industry right now, and everybody and their dog is talking about raising capital. But I think, like I said, I think Andre really drove the point home. But the only thing I would add to it is especially for early stage funding. So we're talking angel, pre-seed, seed. It's not so much the capital that should be shifting the needle. You should be getting that funding because of the strategic investors you want in your cap table. And, so while VC capital may not be for everybody, if, take the capital, if that funder, be it an individual, and Bade sort of like touched on this here where, angels, you choose your angels because of the mentorship, the advisory they can add to the business. For me, so with Hub, for example, so we, to Andre's point, we didn't raise funding. First, because nobody wanted to invest in us. And secondly, when we were thriving, everybody wanted to invest in us. And we were like, no, well, thank you very much. We're actually doing great. And we've scaled this business globally without funding. But what I would say is if you're taking funding in an early stage, like I said, strategic value, advisory, and mentorship, and if anything else is an affirmation, right? So if you get Sequoia investing in you, and I know we're talking later stage now, but having them on your cap table, everybody else will throw money at you. So think about that philosophy when you're at early stage funding around strategic investors more than just the capital. And then the second point I'm making is actually to Joshua's, so the list Joshua added, because yes, absolutely beyond angel, pre-seed, seed, if you look at very earlier, there's also, a lot of grant funding and otherwise. And I find grant funding in particular is very interesting because again, coming from an impact space, so we started with a nonprofit and then grew on to Hub. And while grant funding itself seems very attractive, and don't get me wrong, it absolutely is. There's no such thing as a free lunch, but it's the closest thing you'll get to free money. And that sounds wonderful. And it sounds really attractive. But the only thing I would caution startups and early stage companies is be careful of taking too much grant funding and sustaining your business on grant funding. Grant funding is meant to be catalytic investment. If you get grant funding and for 5 years your business is only being sustained on grant funding, that's not attractive to me as a VC investor because it tells me that if you didn't have that grant funding, you're not going to generate revenue, you're not scaling fast enough. And again, it ties to Andre's point is, you should have a product you can sell and you shouldn't be dependent on something like grant funding. So, while it is attractive, if you're getting too many, it says a lot about your business model and the way your profit mentality, if you will, on how you're looking to grow your business.
Thank you very much, Hema. We've got some really good advice there. The only problem with your advice is when you're really a startup, you don't really know what you guys are saying and you forget it. But it's okay. You can always come back to Founder Institute and come to one of our next sessions and come and hear again what our panelists are saying. Nasipo asks, for equity funding, what percentages do investors or funders normally ask for? And I think let's start with Joshua.
So there's no science to this. It's more of an art, and this is based on the larger conversation about valuations, right? But talking about percentages here, we have two types of investors. The majority investors who want majority shareholding, and some other investors who pretty much want minority shareholding plus packs such as board seats and so on. But just to give an example on typical investments, we see that the sweet spot is usually 10%. And if I can quote the like of YC, invests around 120, now about $500K dollars at is it 7% equity taken, right? So that's usually the sweet spot, especially at the earliest stages when you're talking about angels pre-seed. You don't want to give away too much and in a way be unable to raise follow-up funding from other investors.
Thank you, Murima. Joshua, is there any of the other panelists that wants to add anything there?
Okay, I can add. I think it's important, first of all, again, I keep hammering on this point. You have to, it depends on which stage of your business you are in. It's also very, very much important that founders need to understand that raising fund is a direct linked to dilution. And what we mean by dilution, it means losing the ownership by the founders. The primary objective of founder should be to find fund managers or investors who want to join you without necessarily bringing you down. So if you are in early stage, and we categorize early stage would be pre-seed, seed, and probably pre-series A, your objective should be at most to give out about 10% of your shares at most. And the reason being that by the time you go to Series A, you are most likely going to be looking for funding in exchange of close to 15 to 20% of your shares to make it interesting for those investors at that stage. Remember, at that stage, you are in the growth stage and you need funds to grow exponentially, because that's really where you want to test your hypothesis about the market size that you have earlier alluded to. So when you're in early stage, it is customary that you give a maximum of about 10%. Like it was earlier stated, if you are, there has been some standards set by YC that anything between 7 or thereabout is a good initial investment from either early stage investors or angel list investors. But please don't be surprised that it's a numbers game, okay? Even though at that stage, the most startup really don't have meaningful valuation or means of valuation, like was rightly stated, is an art rather than a science. This is the reason why YC also created the SAFE agreement, which enables you to run away from the valuation question. But as a rule of thumb, my advice is don't give more than 10% at early stage.
Thank you, Bade. Andre, did you want to add something?
Jacobus, just an ad that I want to just put in there is one thing that a rule of thumb, Bade, I hear you on the 10%, but I found that the rule of thumb in the early stages is at every level, you give up about 20%. Yeah, so it's always a if you have seed stage investment, 20% is around about where you're going to do. Series A is then 20% of the post valuation, and again and again and again. It changes as you go along and you grow up with it. But that's about the rule of thumb that you got to play around and work with, and that VCs are reasonably comfortable if they come in and it's a big a bug in very much emerging markets and very much in Africa. It's changed somewhat, but it used to be or it has been quite a bit, is the venture capitalists are extremely greedy. Guys, watch out. Biggest mistake that you can make is to give up too much equity too early. And the problem is you're sitting there with a great product or a solution or something and you need X amount of money. And the VC says, great, I'll give you the money, but I want 40 or 50 or 60% of it. Really, and the problem with that is if you then go to Series A and maybe a Series B, you've got 5% left. You've got no motivation to then build the business. Now, on this, I'm going to throw a caveat in a moment. On this, an interesting story that I always quote, because it's one that always has to keep in mind with the whole basis around where you want to go with things. But please keep in mind, don't give all of your business away at an early stage for a venture capitalist, because he's most probably got some money and it's family or friends, etc., and they're going to give you, $500,000 or $1 million or $50,000, and they want 40% of the business. It does not make sense if it's a family, if it's a lifestyle business that you want $40,000 and 5 of you are going to make some money out of it, maybe that'll work. But if you really want to start building something with scale. Now, an interesting story that comes into this one is Saul Kerzner that built Sun City back in the days in the late 70s, early 80s. They built Sun City in Botswana. It was this modern hotel resort and everything. And he was a developer that had seen the vision of this, built it in the middle of nowhere. And when they initially opened the doors of Sun City, Saul Kerzner had 5% left of the business. at that point in time. It's a very interesting story. He had 5% left, but he was the face of Sun International and of that whole business. He made sure that he was the face of it. So for him to then open up all the rest of his resorts, that then he kept most of the equity on them. So there was a long-term play. But for him to get to the point where he could actually launch, but this is like, after launching, you don't, this is this is Series F. That's his liquidity event. But he had 5% left. So also don't be too greedy and say, you know what, I'm going to hold on to everything. You guys can get nothing. This is the greatest product in the world. Don't forget also that you do need, it's this interesting symbiotic situation with venture capitalists and with funders, because the venture capitalists wants more, but if he's too greedy, you're going to lose. I've seen too many startups build a business and then they've got so little equity left that they're really not excited anymore and they're going to do something else. Because what do we entrepreneurs do? We actually go and we build businesses. If I'm not captured by something that I'm building and it's not exciting me and I'm working for somebody else, and me as an entrepreneur, I'm gone. So interesting, 2 or 3 points there that just put it in. If it works for you, say, okay, this makes sense to me. I'm having a discussion with someone now, or however it slots for you. So on the one side, don't give away too much. On the other side, if you want to get to a certain goal, make sure that you know where you're going with it, but you retain the value. So Sol Kerzner is the face of Sun International worldwide, and they built Atlantis in Dubai now. They've built Atlantis in the US, and he's one of the bigger hotel magnates of around the world. He's done fantastic stuff. But to get to his initial step across the line, he gave it quite a bit of it.
Sorry, let me quickly jump in to buttress the point that Andrew was making. Like I said earlier, please, if you do not need funding, don't go raise funding, because funding brings additional responsibility on your back, right? It's important to note also, as you are starting out your business, simulate your cap table. All right. There are companies that enable you to do that if you do not know how to do it. But simulate your cap table, simulate where you are, how much fund you need, and how much equity you want to give away. If you have a clear purpose of your direction of funding rounds, then it's easier for you to go after those who can see align with whose vision align with yours, rather than just anybody that has money. In any case, if you come to table and you do not know what you're willing to give and what you're willing to take, then you are open to people throwing stuff at you. If you're going out for funding and you know that your business is a $5 million valuation, and then the money that you need today is just about $500,000, don't go and raise $1 million because you think you can raise $1 million. Because once you do that, in that simple calculation, you've given 20% of your equity away, and you've diluted yourself 20% down. And when you go to the next round, you're going to dilute yourself further down. And like last week I said, you wake up more money, a beautiful project of yours, and you're a minority shareholder. And of course, that's also the time that it's possible for the board to take management of you, because now you have little or no stay in your own business.
Thank you very much, Bade. Let's get to the next question. Anonymous, hello Anonymous, asks, what is typical use of funds? Do you want to see what a typical use of funds do you want to see from founders funding requests? I think let's go to Hema. She's the one that's been the quietest so far.
Sure, thank you so much, Jacobus. So I think that's a great question, because asking for money is one thing, but what are you going to do with that money is, for me at least as a VC, it's one of the things I look at beyond, of course, team and some obvious stuff as well, is not just tangibly on what the company is going to be spending the money on, but where again is their mindset and what's their growth vision. There are some general rules of thumb. So like anything, I'm sure everyone gets tired of hearing it, because all our answers start with this is not a science, it's an art. So bad news is there isn't a golden formula on what you should be spending money on, but there certainly are some rules of thumb, if you will. And, so if you think of, and again, we'll talk about early stage, right? Talk about angel, pre-seed, maybe up to seed, right? In the beginning, it's really around, if you know, and I think it's called friends and family and angel, that's really your base early funding to just get your concept proven, your minimal viable product. And I think it ties to another question I saw somewhere in the questions around, product doesn't necessarily only mean something tangible like a phone or a bottle of water. A product can also be a service. And when I say the word products, I'm sure most of the other panelists do, it also applies to service businesses, whether you're doing training, consulting, and there's a whole range that falls under that bigger banner. But your early funding is really to prove concept. You talk about minimal viable product. VCs love the term product market fit, which, depending on who you speak to, means various different things. But spend your early money on showing that what you do makes sense. Every entrepreneur believes what they're doing is the best thing since sliced bread. You wouldn't be doing it if you didn't believe in it. But the best advice that I have a mentor is just because you believe in your product doesn't mean everybody will. So your early funding is to show that the market will respond to you, and that if you have something tangible to show. Very fast after that, it's around if the market is responding, so you need to start showing traction, right? So if you have a minimal viable product, how do you, one, make your product better? How do you scale that, so make more of what works? And what's the next iterations thereof? So, in the early days, it's largely around different types of spending, but spending on product. You do start spending early on staff, but these aren't what we call your expensive hires just yet. You're not going to, and again, my journey, we brought on our first proper market-related salary COO with Wimha when we were 4 years in, because that was only when we could afford it. We couldn't spend money on that early days. But you do, on the flip side, want to spend it on some level of talent. I'm an avid believer, and I know not everybody agrees with this here, but I do believe as a founder, you do need to take some sort of a salary. It doesn't have to be market related. It doesn't have to be, the salary you would have been able to earn in industry. But I think the mindset and the practice, and it shows how serious you take your business if you do pull some sort of a salary from your business as an entrepreneur. I think it's incredibly important. Not all the money, and certainly not proportionate to where else you're spending. I know some people say, you have to show skin in the game and work for free for 5 years. I think driving an entrepreneur in the ground is not fair, and it's not founder friendly. So I get excited when I see early entrepreneurs say they are going to pull some of that for their salary and early hires. And I think the last bit is around marketing, right? And marketing, it's different for different types of businesses. If a founder tells me they're spending 80% of their initial capital on marketing, I have loads of questions. But if they're not spending any money on getting their business out there, that perhaps would also have questions. Having said, we're also living in the age of social media and the like, so there's a lot of, and again, I caution myself when I say this, because while there is some free marketing you could do, I'm an avid believer of doing things deliberately, and I believe you have to spend money to make money, again, proportionately so. So in a smart way, and this is like I said, I wish I could give you amounts and numbers and proportions and formulas. I can't do that, but I could say, like I said, just in summary, it's your concept and product, talent, including yourselves as founders, and then marketing to just be able to get your word out there, be visible, be exposed. And you need to, in your industry, in your specialized field, you need to be on the top of the lips of anybody and everybody whose attention you can get.
Thank you very much. Let's go to IB. IB asks, we're an early stage agri-tech startup close to MVP. How does African investors view single founders, and how does this influence the funding probability? Is Africa a good place for tech companies to raise, and are other location better for tech funding? And I think let's ask Bade for the answer on that one.
Okay, thanks for the question. I think it's a mixed bag about single founder, but generally speaking, I'm an investor, and I typically do not like single founder. The risk is too high. What if something happened to the founder and in the middle of the project and they are unavailable? So I would say that it is extremely very important if you cannot get a co-founder, but at least create a team, an executive management team that has skin in the game as much as you do. But then that again begs the question, if you want that level of commitment, why not make them a co-founder? I also understand that it's difficult to find, it's difficult to take a decision around a co-founder because it's a journey of a lifetime with somebody. So you have to understand who they are extremely very well and their personality. But generally speaking, most of the investors I spoke with are wary of single founder for the simple reason of the risk. Now, as to where it's best to get fintech funding, right now, Africa is actually a good place to get fintech funding if you can find a unique idea that has the potential to scale. Because, if you follow the news around the industry in Africa generally, you find out that most of the companies that are reaching unicorn in Africa are typically fintech companies. And this is because of the gap in the opportunities that are available in Africa. And also, it is easier, it is cheaper. Fintech companies are cheaper in Africa than the rest of the world, particularly the developed world. So you can get a long way with very little fund in Africa than elsewhere today.
Thank you, Bade. Bronson asks, most times responses to funding questions are related to a product. For someone in the services space, what are the guiding principles that one should be looking out for? And what are the elements that would encourage investment? And let's go to Joshua. Joshua, do you have an answer for that one?
Sure. So the underlying elements in both spectrums of the coin between having a tangible product and service and the service business are always the unit economics, right? And for the VC investor, it's all about scalability. So the likes of Swift stuff, the product is basically providing domestic help and assistance to houses and households, which is largely a service business, but they have been able to attract VC funding and have been able to scale. So that's what you need to pretty much prove. Have unit economics that are not so expensive and are flexible and easy to expand.
Thank you, Joshua. Let's go to Leroy. What do founders expect from entrepreneurs before and after funding? And let's ask Andre. This would be the last question.
Jacobus, interesting question there. What yeah, the first thing you expect from an entrepreneur is hard work. But an interesting comment I saw today, somebody posted on LinkedIn about that entrepreneurs should be trained. And I thought to myself, the whole thing about a trained entrepreneur sounds like a trained monkey. An entrepreneur is not, you can't, it's in their blood. It's in what they do. What I'm looking for from an entrepreneur is to keep on doing what you're doing. The reason I've invested in you is you did something right. Keep on doing that. Don't suddenly go and change. Yes, we're all going to pivot, but keep bringing your passion to the table. There's something that I wrote down and always sits on my desk here is that anybody can build products, but not everyone can build a product that solves a real problem and has a real product market fit. So what I'm looking for the entrepreneur is one, don't go and spend my money willy-nilly on champagne and new offices and all those type of things. And spend it on the things that you said you were going to spend it on. Report back frequently enough. This doesn't mean report back to me on a weekly basis. It doesn't mean report back on a monthly basis. It depends what works for both of us. It can be on an hourly, a daily, or a bi-monthly basis, just so that I understand where I'm going with things. But seriously, the thing that one takes a look at and what you expect from an entrepreneur is to go and build the vision and the picture that he sketched from the beginning. Because I buy into that. I come and I bring my hard-earned money and I put it into your business because I like your idea. I like where your head is at. I like what you're doing. Keep doing what you're doing. Probably one of the more important things to understand is that now you have a support structure that sits behind you financially, but also from a mentoring point of view and from an infrastructure point of view and or a network point of view. And this is probably one of the more crucial parts. The money is great, but there's a video of mine that was shot from Net Profit. It's on YouTube. It was 2013. We just come back from a winning App of the Year worldwide, and I did a talk there, and the whole talk was it takes 15 years to become an overnight success. And the reason I was saying that is the whole basis around why does it take that long is it's because of the person that you become and the network that you have. If you speak to me right now, anywhere, any entrepreneur somewhere, I can most probably find you an introduction somewhere that will open a door for you that you would never have got. It's because of this stuff, this gray hair, and many years of networks. When I was with Naspers, we had businesses in 43 countries. I had a conference with the Naspers senior management twice a year somewhere in the world. I used to meet with all those guys, have drinks with them, share workshops, all of that. So that whole network of people of 42 different countries and multiple countries are all still friends of mine. I can still connect with any of them. Now that's only Naspers. Then iFlix. If I want to grow a business in Southeast Asia, in iFlix we launched iFlix in 28 countries in 14 months. We all worked as a core together. If you want an introduction in an emerging market, I can get you venture capital. In Singapore, I can get it for you in Japan. I can get it out of China. I can introduce you to a telco in Thailand. I can get you into, the list continues. I'm not going to carry on with this kind of things. I lived in the UK for 5 years. I have a network there. I've visited America and Silicon Valley. If you're so what I bring to the party is, yes, we bring cash and we bring all of those type of stuff. But what I do is I also bring to you an interesting way that the rest of the world, and this is not me, what I'm saying is the venture capitalists that you deal with, these guys have got experience under their belt and they will bring you introductions. And the key thing around that is ask. Ask. Say, you know what, I need a contract with, we have a great product and we need to get some distribution. Does, whoever you're dealing with as your venture capitalist, do you have somebody to introduce us to get our product in front of? Most of the time, because the guy has got money and he's invested in your business, we'll introduce you to the CEO of a telco, or CEO of a bank, or CEO of a retailer, or CEO of an e-commerce business, because he wants his money he wants a return on his money. So he's going to introduce you to the highest guy that he knows. Do not forget that. Use him as much as he's expecting something from you.
Thank you very much, Andre. Ladies and gentlemen, we have come to the end. Let me just press some appropriate buttons here. There we go. Ladies and gentlemen, we have come to the end of our Q&A with the panelists tonight. Please look on the chat. There is a link for you to go into our meets networking sessions. Some of our panelists as well as the FI members will be there. You'll be able to ask questions. So the meeting doesn't end here. It continues on our networking session. And let me introduce you to Founders Institute quickly, the local leaders Founders Institute, and then we'll go into the networking session.
Now is the best time in human history to start a business. There are big problems that need to be solved, and they're not going to get solved unless entrepreneurs start working on them. I like to say dream big and die trying. We have a big vision to make the world a better place through entrepreneurship. We empower communities of talented and motivated people to launch impactful and enduring startups.
A lot of people who have startup ideas tend to keep it to themselves. You should tell absolutely everyone. Pitch it to as many people as possible, and you learn what pitches resonate. So you learn how to sell the product.
Made us do stuff, not just talk about an idea, but actually build customer base, build an advisory board, build a prototype.
We are all deeply technical people and basically did not understand how to package information and deliver it to investors. Founder Institute was a program where you could actually structure the information about your company in a way that investors like.
They can learn from my mistakes, learn from my experiences, and more important, they can learn how to manage the challenges that they're going to inevitably face as founders. It gives them the skills and confidence they need to get that investor's attention and to move that conversation forward.
There's this narrative that people have an idea, they hide it from the world, then they only reveal their idea to the world when it's perfect. But that's not how great companies are built. Great companies are built through teamwork, through having a support network of people to help you throughout the entire process. Everybody in every Founder Institute cohort shares equity evenly with all of the companies that are created in each program. So you don't have to do it alone. Everybody's incentivized to help you because everybody shares a little bit of your equity.
It's about getting the right folks around you to kind of vet your ideas and really understand, does this make sense? Do I understand the customer? Am I delivering value?
Once you graduate from the Founder Institute, you're not done. You go into our postgraduate programs, which provide you with even more feedback and mentorship and allow you to get to the next milestones for your company.
As a result, your fundraising process is much faster and significantly less overwhelming. Founder Institute is essentially going to be with the founder, supporting the founder for the rest of their company's life.
When you are running a startup, you need direct and brutal feedback. It points out to the real issues that you need to address.
So it was not actually easy to go through it, but if you do the wrong things in actual startup, nobody's going to tell you that. You'll just fail without knowing why.
We're very honest with you. We are hard on you and your idea, but it's all for the sake of helping you build the best company possible.
It's not theory. These aren't case studies. You're not learning about entrepreneurship. These are hardcore business building activities that every great entrepreneur has had to achieve and go through, and we've created a structured approach to optimize it.
We've assembled some of the greatest minds in your city to help you unlock your potential. So join our program and let us build a great company together.
Hello, welcome back, ladies and gentlemen. Let me introduce you to the local leaders of the Founders Institute program in South Africa. And I think the first person up, Keshni, please put on your camera and introduce yourself.
Hi, everybody. Thank you for joining us this evening. It's an absolute pleasure to be hosting you guys. I am one of the local directors for FI South Africa, and I am responsible for partnerships and bringing on mentors into our program. So feel free to connect with me via LinkedIn. If you have any questions around funding as well, shoot them into my DM box on LinkedIn. We will catch you on Air Meet after this. Thank you, Jacobus.
Thank you very much, Keshni. I think our next person that we would like to introduce is Phumzile. Phumzile, can you please introduce yourself? Is Phumzile still with us? Yes, there she is.
Good evening, everybody. My name is Phumzile. I am the PR and Sponsorships Director for FI. Basically responsible for getting publicity and profiling FI in South Africa. And yeah, I look forward to having some of you on the program. Thank you.
Thank you very much, Phumzile. Yes, my name is Jacobus. I am responsible for the founders. So this is the friendliest you'll ever see me. But in general, I make sure that the program runs well, that the founders produce what they say they can produce, and that we have a successful founders at the end of the program. Ladies and gentlemen, that brings us to the end. I want to thank Jitesh. He was doing most of the technical and the background, so you didn't see him, but he was here. And then Anish from Boardroom in a Box. And then to the panelists, thank you very much. Please join us in the M-Meet. And to everybody here, go to the M-Meet, come and meet us, come and meet the Founders Institute leaders and the panelists. If you have any questions, come and join us there, and have a lovely week. Thank you very much. Bye-bye.
Yeah. Please tell me that I can't, that I won't, that I fail, that I'll never make it out, yeah. Please tell me all the bad, never good, fill my head full of every single doubt, yeah. Please say any negative thoughts, I pop off when I hear people say I cannot. I get off to the thought of proving everyone wrong, I won't stop to the top, so you better back off and get lost. I'ma stay loud, stay proud, never running out, never heading south. I'll be spreading out, call it word of mouth, can't put me down, I'll be getting loud. You can have your doubts, not what I'm about, have your fucking clout, it be raining now, I keep making sound, go another round, bitch I'm legend bound, can't stop me now. You don't wanna fuck with me, a slow burn